Okay, so you want to buy an investment property in Australia. Find a house, borrow most of the money from the bank, put a tenant inside, collect the rent every week, and wait while the loan shrinks and the price climbs. It looks like the closest thing this country has to a wealth machine. The bank funds most of it, the tenant helps repay it, the tax system softens the losses, and after 20 or 30 years, you own a house someone else helped pay for. Sometimes it works almost exactly like that. But here's the sentence that should stop you before you sign anything. In Australia, a property can rise in price and still lose you money. Not in a crash, in an ordinary, quiet year where the value goes up and the tenant pays on time. By the end of this, you'll understand exactly how that happens, and you'll understand the one thing about this business almost nobody says out loud. You are not really buying a house at all. Let's start with what an investment property actually is, because it looks like a house and it isn't one. Economically, it's a leveraged bet on a patch of land, with a slowly rotting building bolted on top, wrapped in a tax structure, funded mostly by a bank and partly serviced by a stranger who lives inside it. The house is just the container. Keep that picture in your head, because everything that follows comes back to it. And most Australians who do this are not paying cash. Reserve Bank analysis counted roughly 2.3 million housing investors in 2022 to 23. Around 70% owned a single property. The other 30% owned multiple properties and controlled about half of all investment properties. Nearly 40% came from the highest income fifth of the country. This is a leveraged game played mostly by people who already have money, and leverage is where the whole story turns. Say you buy an established property for $750,000. You put down 20%, which is $150,000, then stamp duty, conveyancing, inspections and loan fees add somewhere near another $35,000 depending on your state. So before a tenant walks in, before $1 of rent, you've committed about $185,000 in cash, and you owe the bank $600,000. Now the rent arrives. Australia's gross rental yield sat near 3.7% in mid-2026. On a $750,000 property, that's about $27,750 a year, or roughly $534 a week. That number is a trap because the word is gross. Gross yield assumes every week is paid and quietly ignores everything else: the property manager, the council and water rates, the landlord insurance, the repairs, the strata levies, the land tax, the 2 weeks a year the place sits empty between tenants. Strip those out and the picture changes fast. Allow 2 vacant weeks and collected rent drops to about $26,700. Then take out the running costs. Management at 7%, roughly $1,870. Council and water around $2,600. Insurance about $1,500. Repairs and maintenance, say $2,500. Compliance and accounting, another $700. That's about $9,200 gone in an ordinary year, with nothing dramatic in it. No burst pipe, no special levy, no storm. What's left is around $17,500. That's what the building earns before the bank is paid. A net operating yield of about 2.3%. Now bring in the loan. In May 2026, a new principal and interest investor loan averaged about 6.31%. A $600,000 mortgage over 30 years at that rate costs roughly $3,718 a month, or about $44,600 a year. The property earned $17,500. The loan costs $44,600. The gap is about $27,100 a year, roughly $521 a week, out of the owner's pocket after the rent is already in. Sit with those two numbers side by side. The tenant pays about $534 a week. The owner tips in another $521. The property needs almost double the advertised rent just to keep running. This is the first thing people get wrong. They line the weekly rent up against the mortgage and assume the tenant is covering most of it. The tenant is covering the rent, the owner is covering the gap between the rent and the entire business. Now, part of that mortgage payment isn't lost. In year one, about $37,700 is interest, but roughly $6,900 pays down the loan itself. That $6,900 becomes equity. It isn't cash in your account, it's cash you've converted into a slightly larger slice of the house. Which means this one property throws off three different numbers at once. The cash shortfall is about $27,100. The tax loss might be about $20,000 depending on your deductions, and the equity gain from principal is about $6,900. Three numbers, same property, same year. None of them means the same thing, and confusing them is how people talk themselves into deals that quietly bleed. Here's where I have to show you the machine underneath, because so far this looks like a business that just loses money every week. Why would 2.3 million people do that on purpose? The answer is that the building is designed to lose money, on paper, while the land does the real work. The tax office lets you depreciate the building and its fixtures. You claim a deduction each year for the structure wearing out, even though the property as a whole is going up in value. On a place like this, depreciation might be worth several $1,000s a year in deductions that never leave your bank account. It's a phantom expense. It makes the property look like it's losing more than it really is, which is exactly the point. A bigger loss on paper means a bigger tax deduction. But here is the part the spruikers skip. Depreciation isn't a gift, it's a loan from your future self. Every dollar you depreciate lowers your cost base, and when you sell, that lower cost base means a larger capital gain to be taxed. The tax you save now, you partly hand back later. Depreciation doesn't erase the cost of the building, it just moves the bill down the road and hopes you've grown enough to cover it. So follow the logic all the way down. The rent barely covers the running costs. The building slowly wears out and is written off. The only part of this whole arrangement that reliably grows is the land underneath it. Strip away the story, and an Australian investment property is this. You borrow heavily against a depreciating structure to get leverage exposure to appreciating dirt, and the tax system pays you to run a loss today in exchange for a claim on your gain tomorrow. That's the engine. The house is scenery. And in 2026, the government reached into that engine and changed two of its parts. First, negative gearing. That's the ordinary situation where a property loses more than it earns, and the loss gets treated under tax rules. Historically, an investor could use that rental loss to reduce tax on other income, including wages. From 1 July 2027, that changes. For established residential properties bought after 7:30 p.m. on 12 May 2026, rental losses can no longer be offset against your salary. They can only be used against residential rental income or the eventual capital gain, with any excess carried forward. Properties held before that date are grandfathered under the old rules. New builds stay exempt and keep full negative gearing. So an investor buying an established home today may have to wait to use the loss, while still funding more than $500 a week in cash right now. The expenses didn't move. The timing of the tax benefit did.
Second, and this is the one that hits the exit, the 50% capital gains tax discount is being replaced from 1 July 2027 with cost-base indexation and a 30% minimum tax on net gains. Remember that depreciation you claimed along the way. It shrank your cost base, and now the machine you sell into taxes gains differently than the one you bought into. The rules under which you built the strategy are not the rules you'll exit under.
That's the reframe. Negative gearing was never the government paying for your investment. It means the investment loses money, and the tax system decides how gently you're allowed to fall. You have to lose first. The refund exists because of the loss, not instead of it. Now, the building itself, because buildings don't age smoothly, they don't send you 1/12 of their wear each month, they wait, then several things fail at once. The hot water system runs perfectly for 7 years and then hands you a $2,500 bill on a Tuesday. The air conditioner dies in the hottest week of summer, a slow leak behind a wall becomes water damage, mold, and a tenant wanting compensation. The strata committee finds concrete cancer and issues every owner a special levy. Your maintenance average doesn't protect you from the timing. You need the cash on the day the invoice lands, and the tax office won't always let you deduct it straight away. Repairs to a defect that existed when you bought can be capital, not an immediate deduction. This is also why passive income is the wrong phrase. Someone has to advertise, screen, sign leases, chase arrears, book repairs, meet safety laws, run inspections, and keep the records. You can pay a manager to do it. That doesn't remove the work, it converts the work into an expense. So let me show you what happens when a property seems to offer everything at once. High rent, strong growth, tight supply, wealthy tenants, and economy printing money. During the mining boom, Newman in Western Australia was one of the most extraordinary property markets in the country. Iron ore region, workers pouring in, mining companies needing housing, supply constrained. By June 2013, the median dwelling was around $875,000. 4 years later, it was around $128,000, a fall of more than 85%, and the rent had collapsed with it. Picture the investor who bought near the top. The yield looked unbeatable. The tenant was tied to a mining company. Local wages were huge. It looked impossible to resist. Then the construction cycle turned. Workers left, housing demand fell, listings piled up all at once, and the rent dropped at the exact moment the price did. That's concentration risk, and leverage turned a bad outcome into a ruinous one. Borrow 80% of $875,000 and you start with a $700,000 loan. When the value falls below $130,000, the building is worth a fraction of the debt. Selling won't repay the bank. Holding means a huge mortgage against collapsed rent. The property didn't fail because Australians stopped needing homes. It failed because too much of its value rode on one industry. And leverage doesn't shrink when the price does. The bank is still owed the original loan. The loss is entirely yours. Now run 2 futures on the $750,000 property and watch the thing I promised at the start. The good year. You fund the shortfall, rent rises 3% a year, costs rise 3%, the rate holds near 6.31%, and the property grows 5% a year. After 5 years, it's worth about $957,000, and the loan is down near $560,000. After selling costs and repaying the mortgage, you walk away with roughly $373,000. Across the deposit, buying costs, and 5 years of shortfalls, you put in about $314,000. Your pre-tax gain is around $59,000. Notice what that means. The property went up more than $200,000, and your actual gain is under a third of that. The investment worked, it just made far less than the price rise suggested. Now run the quiet year, the one that should worry you. Same property, but growth of 2% a year.
After 5 years, it's worth about $828,000. The price went up about $78,000. That sounds like a win. But after selling costs and repaying the loan, you receive about $247,000 against the roughly $314,000 you contributed. That's a pre-tax loss of around $67,000. The price rose, the investor lost money. That is the sentence every new property buyer needs tattooed somewhere they'll see it. A higher sale price does not mean the investment made money. And if prices simply drift down 2% a year instead, the loss runs past $210,000, nearly triple the fall in the property's own value, because leverage magnifies the downside the same way it magnifies the upside.
That's the volatility trap. The price only has to move a little for your equity to move a lot in either direction. It's why the experienced investor doesn't open with "how much will this grow?" They open with the boring questions. What's the true net yield? What's the monthly cash cost? What happens if rates rise 1%? What happens with 8 weeks vacant? What happens with a $15,000 repair, or rent 10% below the agent's guess, or 5 years of flat prices? And the most important one, how long can I hold if everything goes wrong at once? Because property is illiquid. You sell shares in seconds. A house takes preparation, advertising, inspections, negotiation, a buyer's finance, and settlement. And the whole time, the mortgage, rates, insurance, and maintenance keep running. You don't just need enough money to buy, you need enough to avoid being forced to sell. That capacity to hold is what turns a temporary downturn into a survivable one, instead of a permanent loss. There are only 3 ways this actually builds wealth, and it's worth being honest about which ones you control. Cash flow, where rent beats every cost, rare at today's yields and rates unless you buy unusually well or tip in a big deposit. Debt reduction, where each principal payment converts your cash into equity, real but funded by you and the tenant together. And capital growth, where the land becomes worth more. For most negatively geared properties, this is the engine expected to carry the whole return, and it's the one engine you don't control. You control the deposit, the loan, the property, the price you pay, the maintenance, the reserves. You do not control the future market. So, does it work? Yes, it can build serious wealth. It lets you control a large asset with borrowed money, turn part of every repayment into equity, collect rent that rises over time, and, where the rules allow, claim deductions along the way. Over a long enough run, a well-chosen property in a market with durable jobs, population growth, and tight supply can become extraordinarily valuable. But it works for the person who buys with discipline, holds enough cash to survive a bad run, understands the tax timing, avoids betting everything on one town, and who gives rent, debt reduction, and growth time to compound. It works very differently for the person who bought because an agent said property always doubles every 7 years, who has no emergency reserve, whose budget only survives while the place is fully tenanted, and who mistook a tax refund for a return. The tenant is not paying off your property. The tenant is buying housing from your business. The rent is revenue. The mortgage, rates, insurance, maintenance, and tax are costs. The future sale price is the uncertain value of the asset after it all. An Australian investment property is not a house that prints passive income. It's a leveraged bet on land, wearing a building as a costume, and you personally are responsible for every gap between the numbers. That gap is where fortunes are built. It's also where they quietly disappear. So here's where you stand. Take the property you're looking at right now and work out the real weekly shortfall after the mortgage, vacancy, management, rates, insurance, maintenance, and the tax rules that actually apply to your purchase date. Then work out how much annual growth it needs before you truly make a dollar. Put both numbers on the screen. That's your Aussie money standard, not the fantasy, the floor.